Hello and welcome to the ASB Investment Podcast, a show that keeps you up to date on the markets and helps you make smart choices with your investments. I'm Tennent-Brown and I'll be in the driver's seat today, joined by fellow ASB economist Mike Jones. We'll look back on some of the challenges and surprises of the year that's been and chat about what we expect to see in 2021. These are entirely our own views. It's not investment advice, but we know plenty of experts at ASB who will be happy to chat if you need. Hey Mike, well, first time in the booth for you. I've been in here plenty of times, but it's a first for you. What do you think?
I feel a bit like a star, like I just said to you, CDB. We're about to record a duet or something. So I'm just getting used to it, so I might have to sort of warm up as I go.
Yeah. I always feel like I made some bad career choices. Being an economist is pretty boring compared to being a rock and roll star.
Yeah.
And coming to the booth always reminds me when I see all the cool guitars and David Bowie posters and things.
Yeah, I wish I was more talented.
Yeah, but you know, we can only wish that we got better gifts than being good at maths and useless at pretty much everything else. Hey, well, for a bit of background for everyone, I'm the senior economist at ASB, and Mike shares exactly the same job title but has quite a different focus. I'm stuck in the world of thinking about investments, and you think about quite a range of different things. So. You know, ranging from houses, which is probably going to be pretty interesting for people to talk about, but also you've got a massive background in working in Treasury and working at the RBNZ as well. So there's plenty of stuff that I'm going to be asking you for some insights on now that I'm in the driver's seat and doing the interviewing. So, hey, well, let's start off with the impossible to avoid reflection on 2020 and how your holiday was. What did you think when you were having a break from it all over the holidays?
It was nice to have a break, yeah, and I guess it's the same for a lot of people. Gave you a bit of a chance to reflect. Certainly, you know, some gratitude to be in New Zealand and be able to share a beautiful beach with a whole lot of people that were just having a great time. And so, you know, I guess it was reflecting back on the choices that I made and obviously the country and the leadership made around how to cope with COVID, and certainly at the end of the year they felt like the right choices because we were able to sit at the beach and get sunburnt while some parts of the world were in the middle of winter locked in their houses. So that was pretty cool.
Yeah, I thought the same. You know, there's all sorts of experts and opinions and about what we should and shouldn't do over the course of the year. But when you're sitting around watching some cricket and enjoying freedom in the summer, I had to pinch myself sometimes to think life here is pretty normal these days.
Yeah, I tried to stay away from the news, but it only took a 5-minute look at an app, you know, the FT or the New York Times or something, and you certainly got that sense of perspective on how we were tracking in New Zealand relative to elsewhere. Yeah.
And hey, over the course of the year, it certainly panned out pretty differently to what we imagined at times. And I remember back in March, when all this was starting to fire up and get pretty scary for everyone, you were in the thick of buying a house about that time, weren't you?
Yeah, that wasn't a very nice time actually. So I can certainly empathise with people that are trying to buy a house at the moment, where probably conditions are even tougher for a buyer. You know, I often think economists spend lots of time telling people how to think about things and putting forecasts out there, but they're often not very good at making great decisions themselves. And I certainly thought I was one of those when I bought a house, about 2 days before we went into lockdown, and everyone started forecasting big house price declines, including myself, strangely enough. So, certainly a few weeks of cold sweats and no sleep, but got through it. So, and things are, strangely enough, at least in the housing front, looking pretty perky at the moment.
Yeah, it's pretty weird to look back and think in March you'd be going, is this a bad decision? In April you're probably going, this is a terrible decision, and then 9 months later, thank goodness I made that decision because it's got so much tighter. And house prices are just one of those things that in the housing market that just was surprising how it panned out and how quickly things turned around. And hey, it's your job to forecast these things. So how did your thinking sort of change over the course of the year about what would happen with the property market and house prices?
Yeah, you're right, CDB. I mean, if you think about the story for the Kiwi economy last year, I think, there's perhaps two big ones. One was that we escaped lockdown and COVID relatively well. We sort of skirted a potentially disastrous scenario. And the other one was the sheer phenomenal strength in the housing market. And, no one really expected that. We sort of had a 6% decline in house prices forecast around about lockdown, and that looked pretty grim, but that was actually one of the least pessimistic forecasts out there. And here we are. I think instead of a 6% decline for the middle of this year, we're looking more like a 15 or 20% increase. So it's hard to actually imagine a time when economists got something kind of more wrong in that sense. So you naturally sort of think about, well, what didn't we see, or what's going on? And the thing that stand out for me, there's probably a few. One is no one really anticipated, and I certainly mean no one, that the resilience of Kiwis' spending habits. So economists kind of thought, well, we're going into lockdown. We don't know what the world's going to look like in a few months. People are going to lose their jobs. Probably Kiwis will just hunker down, pull their horns in and save a bit of cash. But we did that for about 2 months. We weren't actually allowed to spend, really, if you think about it. And then we came out the other side, and the wallets just flew open. We bought everything we could find, including houses. And so that was one thing I don't think people really understood. And we certainly haven't seen anything like it before. If you think about recessions, I mean, this is the biggest recession we ever had. It's the biggest recession in New Zealand history, and yet people behaved quite a lot differently. And I guess you can rationalise that in hindsight, because it was quite a different recession. So that's one thing I think we underappreciated. And the other one is the housing shortage in New Zealand. We knew there was one. I mean, everyone knew there was one. Everyone's got an estimate of how big it is. But I think it was just that much worse than we thought pre-COVID. And so when we went through 2020 and we got a bit of demand stimulation from low interest rates and other bits and pieces of support, that inflamed the demand side, but supply was just so low that all that happened was you got this big boost going through to prices.
Yeah, one of the other things that I know you pull your hair out is keeping an eye on the population, courtesy of migration, and that's just been all over the place over the last year or two. So really hard to pinpoint actually how much is the population growing by, because those stats have just changed so much. That must have added to the complication of working out how short is this housing market of supply.
Yeah, I mean, you're exactly right. That was another head scratcher. So the population growth more or less stopped overnight one day. And so a bunch of economists thought, well, that's less people in the country, that's less demand for houses, surely that's a negative, which I guess it is. But again, the thing we didn't appreciate was, expats coming back to New Zealand from offshore we just went on a spending spree for houses in the sorts of tiers that owner-occupiers tend to like. And so there's an extra source of demand, even though the number of people coming into the country was less. You saw expats come in with a bit of cash that spent a few years in London or New York, earning some nice foreign currency, and they came back and needed a place for their families, and that just added to that mix. And again, that's not something people kind of expected. Yeah,
and hard to forecast or quantify until after the event, when you've got a bunch of people leaving and a bunch of people arriving, but the people leaving weren't homeowners, but the people arriving potentially want to be. So just an incredibly new mix of conditions. And in my world, again, thinking had to change with investment returns. I've learnt over the years that don't try and time bottoms, because markets will turn around when they want to turn around. It won't be when flags get waved and all the clouds are clear. But the pace which markets turned around was staggering. And for me, the other ingredient there was the pace which things changed from a monetary policy perspective and a government perspective. Back in the global financial crisis, some of the stuff that we did within weeks this time around took months or years to get going in previous recessions, and that adds to the mix as well. Now, you worked in the Reserve Bank. What do you think it would have been like at a time like this when things were happening so fast?
Oh, I was thankful not to be there, put it that way. You've got a certain amount, obviously, of responsibility on your shoulders. The Reserve Bank looks after the financial system, looks after monetary policy and financial stability, and all of that stuff was kind of thrown up in the WAP there. I mean, we were watching, I can remember you and I looking at screens in March, and things were moving around, at a similar sort of pace, or even more than what we saw in the GFC. And so people panicked. Equities were down. I'd come in each morning. Equities were down another 8%. Government bond markets were going crazy. So I guess the Reserve Bank, their challenge is to kind of keep a level head. They want to make sure they've got all the right information and act appropriate. But at the same time, they had to act really fast. There was no scope for mucking around because things are really going crazy. So, I don't think they got everything right. They've sort of said that, but overall, if you look back, I think part of the fact that New Zealand's come through this reasonably well, albeit we've got some challenges in some areas, is down to some of those actions the Reserve Bank took. Yeah.
When I started out doing this job and probably the same sort of time you were in the Reserve Bank, life was a little bit simpler in the sense that all we expected was, hey, well, here's how the economy's going, here's what it means for the outlook, and here's what the official cash rate setting should be and will be. And now we've got all of these moving parts this year. How do you sort of prioritise them when you're thinking about what the Reserve Bank's going to do? And I guess if we start to turn towards 2021, if the economy keeps going well, when do you think they might stop doing some of these things? And there might be some other bits like lending restrictions that they just want to tweak and change over the course of the year. What's your sort of thoughts about the outlook for all things Reserve Bank and the various levers they've got this year?
Yeah, well, as you say, more levers and more complexity, right? It used to be just moving the official cash rate up and down, depending on what was going on. And now they've got, I guess, relative to when I was there, they've got to look at the labour market a bit more closely. They don't just have a inflation objective; they've got the labour market to worry about. And, increasingly, they've got house prices to worry about, not perhaps formally, but the government's asked them to have a pretty good look at, what, if anything, they can do about house prices. And so some of those objectives are moving in kind of the opposite directions. And so what do you do? Yeah,
you'd want to hike rates or do something to tighten things up to slow the housing market down, but that's not going to help with your inflation or let alone your labour market
That's
outlook.
Right.
Yeah.
And you can't set different interest rates for different sectors, right?
Yeah.
So it's a tough balancing act. We are probably at risk of asking a little bit much from the central bank. But look, to answer your original question, the money question, I think the Reserve Bank's probably stimulated the economy enough. So there was obviously talk about negative interest rates, which we can talk a lot about if we're forced to. We've talked a lot about it last year. It was a real thorny issue that we had to tackle. But no, I think the tide's gone out a bit on negative interest rates, both whether or not they're a good idea, and also do we even need them?
It'd be nice not to, wouldn't it? Make life a lot simpler for everyone to not have that as an issue to deal with, even though we, as banks, had to get ready for it at the end of last year, but to not have to do it would be preferable, I've always thought. Yeah,
we all had to get ready for it, get our heads around what it might mean and whether or not we thought it was a good idea. But I guess the best case scenario for everyone is that we don't have to go there, right? Because the economy doesn't need it. So that's kind of the scenario we're looking at. I kind of think the scenario is a long time with the official cash rate where it is. But the bank, I think this is going to be a year of alternative tools, both from the Reserve Bank and maybe even the government. So you've kind of got an economy that's, past the worst, but still pretty fragile, licking wounds in certain sectors undoubtedly, but you've got the housing boom, right, which something has to give and we need to take some action on. If you ask, various sectors and parts of the government. And so the Reserve Bank will probably look at something to target house prices, and the government's obviously signal they're going to take some action or introduce something new in the end of February as well. So I think that's probably going to be the big themes for this year. Hopefully we don't go back to the the negative rates debate.
Yeah, I when people ask me about mortgage rates, which is one of the things I have to forecast.
I was just going to ask you about that, yeah.
Yeah, I always hope that actually this is as low as they get, and the next conversation will be about them going up. Not because I want to pay a higher mortgage rate, but I'd kind of like to think that over the course of the next 2 or 3 years, the economy returns to normal, and we no longer need emergency settings, so rates get a little bit higher on the back of that. But it doesn't seem like something that's going to happen while there's so much uncertainty. And then we've got that other complexity, and another tool that the Reserve Bank brought in last year, which is this funding facility. But that doesn't seem to have been having a big impact on the stuff I look at yet. And what's your thoughts on that funding facility, and whether or not it'll be another thing which keeps rates low over the course of the year?
Yeah, so the funding for lending scheme, I think that's already starting to drag rates lower. I mean, it hasn't had a big take-up yet, but we always said it was going to be a bit of a slow burn. Banks will rotate a bit of funding onto that as it falls due and as it becomes available. So we've seen a little bit of that so far, and as you would have seen, some big cuts to mortgage rates already this year, so I think it is having an impact. But yeah, I mean, in terms of mortgage rates, what are your thoughts there, CDB? You're in charge. That's your sort of department. I can throw the spotlight back onto you on that front.
This isn't the first time I've said that they must be near as low as they can get, and yet they keep getting lower. You get something like a 2.29% mortgage, the lowest that's ever been offered in New Zealand. And then the question that we discuss is not, hey, should I lock and load that in? The lowest ever sounds pretty good. It's, do you think they'll get a little bit lower? And I'm a pretty simple guy. I always start by just looking around the world and going, well, what's happening in other countries like Aussie or the UK, where they've got a similar sort of framework to us, and they did get a bit lower there. You could get a sub 2% mortgage in Aussie, and I've thought that's where the risk lies, and obviously the offsetting risk to the mortgages going lower is what I was mentioning before, is the economy just gets going better and better and better, and we get surprised that, hey, the Reserve Bank wants to start tightening up. But I think that's a story for a few years down the track, and we're in some sort of point now where near the lows. I'd still like to think that they'll go a little bit lower, largely because I think you're right, that funding for lending facility is slowly putting downward pressure on other things like term deposits. But the economy going pretty well is an offsetting influence. I thought when we were talking about the cash rate getting cut even further, we'd definitely see lower mortgages. Whereas now I think they can probably just squeeze a little bit lower than where they are today. And we've seen that over the last couple of weeks, with the main banks chipping them down from sort of 2.5% to 2.29%. Maybe we'll see a little bit of jockeying over these next few busy months for housing. And hey, it's not just houses that benefit from that, and I guess this is a question for the year ahead, is how do these low rates flow through to businesses, and what are the corporates you talk to out there thinking about the environment and the year ahead? What are some of the issues that they're raising?
Yeah, well, that's an interesting one, and that's sort of been changing. I mean, I'm as a slight sidetrack, just looking at the labour market at the moment, as of today, actually, what we can expect. And it's only been 3 months, and the biggest issue facing the labour market's kind of shifted from how many jobs are going to go as a result of this COVID recession. That used to be the big issue, to the skill shortages that are developing and businesses are telling us about. So undoubtedly, there's certain sectors of the economy where there are still job losses happening. But at a macro level, we may be close to the end of that process, which is great. But the thing for business, the things that corporates are telling us, both, I guess, anecdotally and in some of the surveys, is that they just can't get labour. They can't get the skilled labour that they need, and actually unskilled as well. So, what does that mean? What does that mean for the economy? We're probably going to stay in this position with the borders sort of largely shut for most of the year, so you can't necessarily source offshore workers. We're not going to have that migration coming into the country, so we're going to see a bit more wage inflation coming through, or a bit more cost pressure for business. I mean, that's one that's coming up a lot. So we had this issue, I guess, that really reached fever pitch around Christmas time, which was goods pressure not being able to get enough imports into the country, and that's put some supply costs push through in certain areas. Now we're looking at some issues with labour as well, and some cost push there. So that's a big theme with business. Undoubtedly, I think the thing that in my world, when I go talk to corporates, they mostly say to me as well, things are going. We can't kind of understand how well things have gone for us. We had pretty low expectations, obviously, going into a recession that everyone was telling us was going to be the worst on record. But things have kind of turned out pretty well. But there's always the sense of it can't last forever. We're kind of waiting for things to dry up a bit. So it's a real caution. I think it's a real caution out there. And businesses are understandably keeping their powder pretty dry, looking not too far ahead, being pretty reluctant to commit to big investment decisions, big hiring plans, because, let's remember we're still in a position that no one would have thought would be in 3 months or 6 months ago.
Yeah, some of the stuff that you're talking about there, there's some COVID related things like the uncertainty and some of these global supply chain issues and migration changing, and clearly that impacts massively on the tourism and hospitality. But some of those other issues are actually things that we were worried about and that corporates were telling us 12 months ago, is that, hey, there's starting to get some constraints which are going to slow growth. I don't know about you, but I always like my forecasts being right. But when you get something like the labour market going so much better than what we forecast, even though there's still some troubles, it's quite a nice forecast to get wrong, isn't it? We were worrying about 10% unemployment, and here we are. It's not even half that at this stage. But I saw in your forecast you still think it'll creep up a little bit over the course of this year. What's behind that?
Yeah, well, so we're not past the worst, I guess, in an unemployment rate sense. What we do think is, maybe the job losses as a whole might be drawing to a close, but we're still probably, the economy as a whole probably isn't generating enough jobs for the population growth that's still occurring, right? So there's still growth in the labour force, and as I said, businesses aren't necessarily hiring aggressively, so labour demand's not quite enough to keep pace with that natural growth in the labour force. So that means the unemployment goes up a bit. But yeah, to your point, we're talking about an unemployment rate that could be 5.5%, 6%, somewhere around there, maybe a smidge above 6. But again, cast your mind back. Everyone was talking about 8, 9, 10. I mean, some people were talking about 20. These are the numbers that are going around and sort of frightening people. So again, that's a great result given where we've been. But no doubt we've got new challenges for this year. I mean, the tourism industry is one, which brings me to another point, which is, I guess, we're seeing quite a mixed picture, right? And this is something you'll be seeing as well, maybe on the investment side. But COVID's affected sectors of the economy really differently, and as a result, different regions really differently. So you're seeing some absolutely booming, some parts of the country, particularly those that are exposed to sort of rural and primary industries. Some really struggling, which is obviously tourism for the most part, but also some parts of manufacturing as well, retail and hospo. So that's showing up in some of the data that we look at. But I mean, is that something that's coming through, I guess, on the investment side? I mean, how do you, I guess, first of all, how did that all pan out last year? I mean, there was some surprises there as well, and how things looking for this year? Yeah,
I reflected a lot in the early part of the year, because one of my jobs is to write up the investment returns for the year. So I came straight back into the office on the after New Year's and started writing them up. And two sort of observations. One was, it just seemed surreal to be wandering around, enjoying summer, watching America's Cup racing, that freedom we talked about before. It's just amazing. But it occurred to me, wow, all of these operators would be swarming with tourists if the borders were open. And there are a lot of people looking, but nowhere near the number of people that would have been there if we had tourists. So it sort of highlighted an area of weakness, and hospitality, stocks that are exposed to tourism, like Air New Zealand, the airport, still reflect that massive strain. But when I went back to my desk and I'm doing things like downloading the share market returns over the full 12-month period, if you only checked your investment balance at the start of each year, you'd just look at it and think, oh well, that was another reasonable year. Our market was up double-digit gains. Everything looks good on a 12-month basis, and it just behind the details to think, wow, markets were down 30% or more during one quarter. People were talking about switching funds to preserve capital and all of that sort of stuff, and then to go, wow, at the end of a 12-month period, it's actually been a pretty decent year for everything from international shares, New Zealand shares, KiwiSaver returns. But boy, what a hell of a ride, and it really does rattle people. Now, when we look at the long-term returns for KiwiSaver, they've got two massive downturns in it with the global financial crisis and then this year. But the speed that we recovered was staggering for share markets compared to the GFC, where it was really impacting returns for quite a long time because it took quite a while for markets to turn around.
Yeah. So why do you think that is? I mean, why did we have that sort of V shape in shares that was so much more aggressive this time than the GFC, when everyone was sort of saying that this was a recession that was worse? And it was synchronized, right, as well. The whole world kind of went into recession at the same time. Whereas GFC, everyone kind of, there was a bit more
dribbled into it. Yeah, I think looking over the year, the thing which staggers me is just the swiftness of the pace that central banks responded, and governments were just prepared to throw everything at it. So I think investors, that clearly had an impact on the bond market when central banks are just out there buying bonds. That helped portfolios. But just the swiftness of the response, I think investors made the right decision to go, companies are going to turn around. And the comments you're making about companies going, well, we're actually going quite well, is I think what investors probably thought when they looked at it in April, going, this is a bigger than ever stimulus we're seeing, and this should help. And here we are, another lesson that monetary and fiscal policy works. The elephant in the room is that there's a huge amount of government debt associated with that remedy, but it sure did work from holding up employment, keeping companies supported and going. So
we'll worry about the debt later, right?
Yeah.
So do you think it can continue? Because we've got a new US president now, Mr. Biden, which I know you follow quite closely, and he's talking about almost $2 trillion worth of US stimulus on top of the stuff the US has already delivered. So does that mean kind of more of the same for investment markets?
Yeah, now we get all these wacky new theories like modern monetary theory, where governments just can run deficits forever and ever. I'm not quite sure what I think of that. But in the near term, it's pretty hard to forecast a bad time for the share markets when the economy's getting so much support. I'm sure over the next few weeks we'll see plenty of horse trading like we always see with US politics until they get a final deal. But the intention looks clear there, and the pathway, what I kind of hope is that the pathway to get this stuff through, whatever form they finally get through, is perhaps a little bit smoother. Where in the near term, not going to be able to find out what's going to happen by following a Twitter account, but maybe we've got a more stable year ahead. That's kind of my take on it, and I think there's a huge amount of support. And hey, one bit of news that I know is not fake news is there are people getting vaccines in the States. I called up my dad, and he got his first of 2 doses last Friday. So that's a big part of the outlook too, I reckon, is just how smooth this rollout of the vaccine goes, and how and a lot of that recovery in the share market towards the end of last year was to me about that, just confidence that we're going to have a lot of support for economies, but also we're right to be optimistic that 2021 should be a bit better than 2020. Hey, so putting each other on the spot for a wrap up, what's your pick to where houses will be at the end of 2021?
The cost of houses?
Yeah. What sort of number do you think house prices will go up on average over the course of this, over 2021? Sort of flat from here, 5%, another 10%? Any picks?
Well, house prices went up, believe it or not, 17% in 2020. We've just learned the sort of semi-official numbers have just come out. And in fact, I had a call with some folk in Canada about the New Zealand housing market as an aside, and I said that they'd gone up 17%, and they called me on it. They said, no, that can't be right. And I said, no, it's right, 17%. And they were kind of blown away. But they might be more blown away at the end of this year, because we actually think they'll probably go up another decent amount, probably more than double digits. We've got formally a 12% increase on top of last year's pegged for 2021. And the reason for that is basically that, if you look at all the drivers that I guess caused the housing boom in last year, they're all still more or less with us. And in fact, some of them are even intensifying. So, you've talked about mortgage rates. They fell for most of last year, and we've seen some pretty steep cuts already this year. And as you said, they'll probably remain under a bit of downward pressure. And the supply-demand imbalance, the supply issue is really critical. And supply, if anything, is becoming even tighter than where we were end of or middle of last year. So we just haven't built enough homes, and demand is too strong for the amount of supply that's in the market. And so if you look at sort of some of the short-term indicators that we look at, they're sort of saying, well, house prices could actually go up to a rate of house price inflation of 20% or 25% before we see any sort of cooling. Now, clearly, the fact that we're looking at a 12% increase by the end of the year means we're expecting some cooling. So there is a few things changing on that front. So the big one's probably the change in the LVRs. So investors, as we know, as we've heard, got into the market in a pretty aggressive way last year. The LVRs are coming back on for investors, and so that will slow that part of the market. We think that'll cause things to cool down a little bit. And we're going to see some of the stimulus measures that we saw last year when everything was sort of thrown at the economy. Some of those are going to start to wind down in the first part of this year. So again, that's a bit less stimulus. It'll probably find its way into the housing market. So there are some signs that things might start to cool off, but not to probably the latter part of this year. And we are starting to see supply increase as well. Some pretty big sort of consenting numbers coming through as well. So at some stage, we'll see that market in a perhaps a more even state of balance. But
still plenty of pressure on the prices in the term anyway. And I think it'll be fascinating to read. And all Mike's research on housing is available on our website and really worth having a look at if you're interested in it. I don't want to make a pick for the share market.
I was just about to ask.
My forecast, if you'd asked me in March, would have been probably about as dire as everyone was worried about. I found it really hard to imagine that the year would turn out to be a positive one, and yet it was pretty normal. Over the long run, I expect sort of 6 to 10% from things like shares and growth funds over the long term. And same as you said, there's a lot of positive drivers there to support shares, just like there are to support property. I guess the thing that I'm the most confident in is that the return on cash and term deposits just going to remain really low over the course of the year, and it's an environment that's pretty supportive for growth assets. But as we learned last year, the journey can be pretty wild, and there's always plenty of risk. So I just try and keep my focus on the long term and not get too freaked out when that bad news comes along, and hopefully that's what our investors do too. Hey, so we can't do a podcast without mentioning Donald Trump by name. I think he appeared in every single podcast that I was on last year because he was just centre stage. How do you feel about that transition of?
I was going to ask if you still have to look at Twitter now, CDB, for your morning wrap ups. Have you sort of unsubscribed from Twitter? Are you expecting we're going to have a calmer year for politics?
I quite like the idea that now when the share markets are down, I have to look for a company announcement that drove it rather than just go straight to Donald Trump's Twitter feed and see what he did. But it feels like there's been this eerie silence. It was a pretty shocking crescendo.
Yeah,
but an eerie silence since the 20th. I won't say I miss it, but it is different to not be getting that constant barrage of information about the politics. And I just hope it means that it's a slightly smoother sailing over the year ahead, but I'm sure there'll still be some bumps. What about you?
Yeah, well, it should in theory give us a slightly more, I guess, predictable investment landscape. Biden's a bit more of a traditional operator, I suppose, is one way to phrase it. And I guess positive from the perspective of the stimulus he's talking about unleashing on the economy in the US. I mean, that's clearly boosted kind of expectations to the economy and share markets. So But other than that, I wouldn't want to say too much, right? It's been such a volatile few years for politics. I mean, I used to, it was only 5 or 10 years ago I was busy telling everyone that politics doesn't matter for markets anymore. Just look at the fundamentals. But clearly,
in the US
that
case
changed a bit.
Yeah, in the US in particular, there's just so much change. Well, it'll just be one of those variables we have to keep an eye on.
Indeed.
Hey, it's been awesome chatting with you, and I'll definitely hope that we check back in before the end of the year, but we'll keep an eye on those price gains in the houses, and thanks for your time for coming in today and talking about so many different things.
No, thank you, CDB. It was a pleasure. Great to chat.
Good stuff. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on today's episode, or if there's anything you'd like us to discuss on a future show, get in touch at podcasts@asb.co.nz.